In this video, we'll discuss the top 3 option strategies for small account and how to increase and boost your return efficiently. And then we'll take a deeper look at 12 option example that I have open right now in my account and how it have been performing over the last few months. Let's dive in. A small account can also open trade options depending on the cash that they want to invest in each of these options. There is different strategies that will allow you to invest for as little as 500 or as big as 5,000 or more. There is no really limitation on what you can do in the option world on a specific stock. If you are bullish on it, then you have several strategies to use, as well as if you are bearish on the stock. In this video, we will discuss the top 3 option strategies that will benefit from the stock being a little bit bullish or neutral, or might even go down just a little bit, while you are able to achieve the full amount of profit for your trade. The first option strategy, and my personal favor, is the poor man cover call, also known as synthetic cover call. Let me give you a quick review about poor man cover call. The poor man cover call option strategies work by buying a call deep in the money and then selling a call against it. The call that we're buying deep in the money at further date will simulate us having 100 share of the stock. Using that will give us the leverage to sell cover call on it. The combination of the two will be called the poor man cover call or synthetic cover call. Let's quickly analyze this trade. We are buying the $15 strike that expired January 17, 2025 for 7.48, while simultaneously selling the $22 strike price that expired on August 16 for $2.15 per share or $215 per contract. The limit price that I entered for this trade was 5.34 debit. That means I'm paying $534 per contract. Since I'm opening 5 contracts here, total debit or cost for my account was $2,666. The maximum profit for this trade is easily calculated by the difference between the call that we are buying versus the call that we are selling. So as you can see, if we bought for 15 and then sold for 22, that's $7 different, or 700 per contract. Assuming Robinhood will end August 16 on or above $22. However, we can even achieve higher trade by rolling over the 22 into further date, especially if the price of Robinhood was very close to 22 or even a little bit lower. In that case, it will just basically expire out of the money and we'll be able to sell a new cover call and collect more premium. The furthest date we can go here is the January 17, 2025, since that's when our $15 call that we bought that is simulating the 100 share are expiring. I opened this trade a little bit more than a month ago on May 31st. As you can see, the average cost that cost me is $533 per contract. The expiration date, they will put the short leg of the trade first, which is the call that we sold, the $22, and then the long leg of the trade, which is the call that we bought, the $15. You can see right now I have an unrealized gain of 19%, which is 509. If we scroll back up, you will see here that the value right now for this option is $6.35 per share or $635 per contract. The beauty about the poor man cover call option strategy is that you might able to collect your full profit way ahead of the expiration date. And it's your call if you want to close the trade or you want to keep it up and try to roll over the short leg into further date to collect more premium. So in this case, as you can see, like we said, the maximum profit is $7. And we have plenty of time. Like we only had this option open for 1 month and we still have at least another 2 months for the short leg to expire. But we are already 20% or close to 20% up, which is 509 on these 5 contracts. If I chose to close it right now, I can collect this profit and just start a new trade, or I can wait and see if I can collect more credit. Since right now Robinhood is at 22.3, which is right at the short leg, if the price continue within this range, it will be so easy to roll over the $22 into further date and collect more credit. Like for example, if we went to the trade option, we change it to the August 16 and said, hey, we want to buy to close the $22 and we want to sell here, for example, the $23. In this case, we are possibly collecting an additional $1 per share or $100 per contract, while at the same time receiving a credit or $50 per share or $50 per contract. That's absolutely amazing. It's a win-win for us. And we can do even more and better. The maximum we can go, as we said before, is the January 17th, since this is where we have the $15 call that we bought. And you can see here I have the +5 for the 5 contract that's currently open. So in this case, I can go and sell, for example, the $25. And as you can see, like again, it's a win-win scenario for me. I can move the sell from $22 to 25 while simultaneously collecting $113 per contract. Absolutely great. The best that I can do right now is just wait. Since the strike price is in a perfect position, we can wait for it to get closer to the date and see how it's going to play out. My goal is to buy the $22 strike to close as low as possible, or just let it expire out of the money if the price drop under 22. And this will give me the maximum profit when opening a new short leg on this poor man cover call. Let's jump to the next name on our list. We have Tesla. I can show you here. I have also a poor man cover call on Tesla. I have opened it on May 31st. I paid an average of 29.60. Let's scroll down. This is the detail for the trade. Again, I have a $42.5 unrealized profit, which is $1,260 that I can collect right now, way before the expiration date, just because the stock went up. If you look at the value right now, you will see it's actually exceeding the $40. It's 42.28. Similar to the example we saw on Robinhood, we can also roll over the short leg of the trade if we want to increase our profit beyond the $42. So if we go here to the September, so here we'll say we're gonna buy the 190 and then we are simultaneously going to sell. Let's go all the way to January, the same day that we have the 150 open. So if we came here and we say, for example, let's say the 200, as you can see, we are able to roll it over and sell the 200. We are going to collect a credit of 343 per contract, while at the same time collecting an additional possibly 1,000 profit appreciation between the 190 to 200. The third name that I'm playing poor man cover call on it is PLTR, and I have currently two different option strategies that's currently open. Here you can see the details, been open on June 3rd. I have a 2 contract. I paid an average cost of 10.20 or $1,020 per contract. I have an unrealized profit of 30%, which is 631. You can see here in the history the full details about the trade. I also have another one on PLTR. This one I took a longer time frame and I opened another 2 contract. It was open at the same date, which is June 3rd. I paid a $10.27 per share. I also have an unrealized gain of 23.47 or $476. If we scroll down here, you will see the details for this trade, what time it was open. So these are the 4 poor man cover call option strategy that I have in my account open right now. And as you just saw, all 4 of them are actually positive. They have an unrealized gain close to the maximum, way ahead of the expiration date. So you can see why I love poor man cover call option strategy. It gave me almost the maximum return way ahead of before the expiration date. So in this case, I can close it just in case the stock dip down deep, then I won't be even affected in it since I already collected my maximum profit and I can just move on to open a new trade. In some of them, since you see I have a high confidence in these names, I will let it run a little bit more. My goal will be to roll over the short leg to a higher strike while collecting premium to increase even more my return on these trades. In all 4 poor man cover call option strategy, we use much lower cost or a debit to our account comparing to just buying 100 share of the stocks and then selling a cover call against it. So as you can see here, for this trade, I used 533. That was my average cost per option. Compare that to buying 100 share of the stocks, which was at the time maybe $20. That's going to be 4 times this amount. It will be 2,000 instead of 500 for basically achieving the same return. In Tesla example, we use only $3,000 to get a great return instead of buying 100 share at, I remember the share was about maybe 180 or 170. That means $17,000 to $18,000. We only use a fraction of that amount to generate a great return on our money. Similar for PLTR, you see the average cost for the 2 contracts that's open right now was $1,020 instead of putting $2,500, and similar for the other one. Let's jump to the second option trading strategy we have. Put credit spread. Put credit spread is when you sell a put against a specific stock and simultaneously buying a put lower in it to limit the cash collateral for you in that trade, and also is considered you are limiting your risk for that trade. So let's take a look at Google and explain it from there. This is the full trade details for Google. I have opened this on December 28, 2023. I saw the Google 120 strike put for January 17, 2025 for $6.34. And at the same time, I bought Google the $100 strike put for the same date for $274 per contract. That resulted in a total credit for the two contract of $720 to my account. So I'm collecting 720 credits right now for a trade that have a maximum risk of losing 2,000, which is the difference between 100 to 120 multiplied by 100 share. We receive 360 while we can sell it right now, or we can buy to close actually for $32. The unrealized return is 91% or 656. This put credit spread still have 7 months to expiration, but we are collecting amazing return. There's nothing preventing us from closing it ahead of time. If you are expecting Google to dip, or you think it might dip under the 120, in this case, I don't really think Google will dip under the 120, so I might not close it right now. I will wait a little bit more. But if this price keep dropping, I might close it ahead of time and just use that cash collateral to invest in a different option. Let's take another example for the put credit spread. In this case, I have a put credit spread on Intel, INTC. I sold the 35 and I bought the $25 put. You can see right now the value for these options is 366 per contract. The average credit that I received was 306, meaning I'm down on this trade since Intel have dropped down since I opened this contract. I have opened it on April 5th. As you can see, I have a -3, meaning I have a 3 contract open against me. I have opened the first two on April 5th. You can see here all the details for the sell and the buy, the amount that I received and the amount that I paid. And this was the net credit that I received. Since the price of Intel kept dropping and I really wanted to average down, I went and opened another put credit, but I received much higher credit in this case. You can see I did the same thing. I sold the 35, I bought the 25, but I received a bigger amount, so it resulted in 452 total credit. That took my average credit received to 306 per contract. If you see the price fluctuation for this contract, you can see here when it went up and down and how it's changing based on the stock. It was much bigger negative against me just a few days ago, but since today was a big update, it's recovered a lot of the losses. I'm not worried about it since I have plenty of time. I have about 7 months to expiration, which definitely the stock has plenty of time to rally. And even with like just a rally from today, you can see I'm almost close to the $35, which is, as long as I end the stock price above that, I'll be more than happy. Next, I want to show you my put credit spread against Nvidia. I sold the $70 and I bought the $60 that expire beginning of next year, January 17, 2025. I have opened that on January 27, meaning about 2 weeks ago. The average credit I received 58. Right now, if I want to buy to close, is 43, meaning it's a little bit positive for me by $30 or 25%. Let me scroll down and show you the trade here. You can see the detail when exactly it was open. You can see how much I received and how much I paid for the other. And this is the total estimated credit that I received. The final put credit spread that I want to show you is another one on Nvidia. I went for a longer time frame this time, all the way to 2026. I have sold it on the same date on January 27. I received an average credit or $125 per contract. Right now, if I want to buy to close, it's 110, meaning lower. So it's a positive for me, plus $30 or 12%. These are the details of the trade. In put credit spread, you are going to generate a higher percentage return on the cash collateral that you have invested in that name. For example, between the 60 to 50, it took me 1,000 cash collateral to open this trade for each contract, while at the same time receiving 125 credit. Actually, I do have another put credit spread on Tesla that I want to show you. I have sold the 150 and bought the 100 put. Let's go down here and see the details. I opened it on January 24. I have -3 since it's 3 contract. I have collected an average credit of 11.37 per share or $1,137 per contract. You can see right now I can buy to close for 2.76. Absolutely amazing. It's a big profit. You can see it's the unrealized return is plus 75% or 2,583. Okay, I guess I have more put Chris spread than I realized. I mean, it is one of my absolute favorite along with the poor man cover call option strategy. So I promise this is the last one I have in the Netflix. I sold the 350 and I bought the 300. You already saw many examples, so I'm not gonna go through the details, but you can see the unrealized return is plus 76%. Again, absolutely amazing. If we scroll down here, this is the detail for when I open the put credit spread. The third and final option strategy that I have for you is the call debit spread or bull debit spread. If we check the one that I have on Netflix here, I have bought the 400 and sold the 500 call. A quick reminder of the basic for the bull debit spread is when you buy a call on a specific date and simultaneously selling another call against it at a higher strike price, resulting in a debit or cost to your account. So in this case, you can see I bought the $400 call that expired on January 17, 2025, and I paid $15,158 per contract. But at the same time, I sold the Netflix 500 call that expired in the same date for a credit of $9,996 per contract. That resulted in a debit or a cost to my account of $5,162 for a possible return of $10,000. So almost double. Right now, if we scroll down, you will see that I have an unrealized return profit of plus 75% or 3,916. You can see the value for the bull debit spread is 9,078 per contract. And finally, let me show you the option that I have on PLTR. This is also a call debit spread. I am buying the $12 while simultaneously selling the $20. You can see here the average cost on me, I pay $389 per contract. I have a 3 contract that was open on December 18, 2023. Expiring beginning of next year, and I have an unrealized gain of 76% or 897. You can count the maximum profit, which is the difference between the 12 to 20, meaning $8 per share or $800 per contract. So I am going to wait for this contract to achieve the full value for it. The average cost for my Netflix call debit spread is $5,162. I know it's a lot, but it's much lower than buying 100 share for $400 per share, meaning that's $40,000 to sell a cover call for 500, or I just use 5,000 to sell a call for 500. So I use 1/8 of the amount to achieve the same cover call using a poor man cover call, meaning I am elevating my return by a big time, because now whatever return I get is divided on the 5,162 instead of dividing on a $40,000 invested. Similar thing for PLTR. You can see here that the average cost was $389 instead of buying 100 share, which will cost us much more than that. Let me know in the comment if you have played with these 3 option strategy and how was the return for you. Was it a positive return or negative return? Please let me know. I would like to hear from you. If you find this video useful, please consider giving a thumbs up, subscribe to the channel. As always, the information provided in this video is for educational purpose only and should not be constructed as a financial advice. Investing involves risk, including the potential loss of principal. Thank you guys and see you in the next video.